Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've actually been following his work on Twitter for a while now. He covers gold and silver, precious metals, uranium, energy, base metals, and battery metals. And he runs the Silver Chartist website, which has technical analysis and fundamental analysis. I think he outsources the fundamental analysis on mining stocks. Steve Penny of the Silver Chartist. Thank you for joining me.
You bet, Jason. Thanks for inviting me on. It's a pleasure to speak with you. I've been following you for a while as well. I remember first hearing you, it seems like 10 plus years ago on an SGT report, and I've been listening to you on George Gammon. So looking forward to a great conversation.
Excellent. So I want to get your thoughts here on the global macro. We were actually discussing this before we started recording. There's just so much going on. The Fed is claiming right now that it's fighting inflation. They're claiming that they're going to be able to keep raising interest rates. What are your views on the current global macro situation with the global economy and central banks?
Well, I like to go really big and then zero into small. So super big picture, the United States government and governments around the world have a problem where they can either choose to inflate away the debts or default honestly. And we know the history suggests they're never going to default honestly, but it is mathematically impossible for them to make good on these unfunded contingent liabilities and the debt that we have. So the only choice is to debase. That's the only political viable option. And you and I were talking beforehand and we said, what's a 4-letter word for why they have to debase the currency? And that's math. It's simple math. So they can play maybe some games here in the short run, but over the bigger picture, for the next couple of years, I think, we're going to see massive currency debasement and precious metals and hard assets stand to benefit from that.
So the Fed has claimed that quantitative easing ended in March. They're saying that they're going to be able to reduce their official balance sheet, I think 90 billion per month. We're seeing from Occupy Feds on Twitter, they track the actual Federal Reserve Bank data that's releasing and the data that's being released by the New York Fed or other sources. So they're releasing this information on multiple websites and at multiple times. The data doesn't match. So this quantitative easing that supposedly ended in March, I was arguing on Twitter with the former New York Federal Reserve Bank trader who was adamant that 3 to 4 weeks after quantitative easing ended in March, that the Fed's balance sheet would start to reduce, that the reinvestment of other bonds and interest and all that would start to reduce the balance sheet. He's wrong as usual. He's spinning things and lying like a lot of other federal government employees. So do you think then that the Fed can get away with pretending to be the inflation firefighter while they're really the arsonist for a lot longer?
Well, for a lot longer is the caveat there. No, not for a lot longer. Maybe a little bit longer. I mean, they've been doing this for a while. I remember Jim Sinclair used to call it management of perspective economics. And it's all about, jawboning and managing perceptions. And I think the average person is starting to wake up to what's going on. But the question remains, can they kick the can just a little bit further? But I think in the next quarter or two is when things really start to unravel. I think we're coming to that critical juncture where they're going to have to choose. Do they absolutely crush the economy or do they allow inflation to run hot? And I think they're going to sacrifice the dollar in the next quarter or two.
And we're recording this interview on Thursday, June 30th. The dollar index is actually at above 104 right now. So the dollar relative to other fiat currencies, and fiat currencies, I think, in my opinion, Steve, are all garbage. The dollar right now is the best or the cleanest shirt in the dirty laundry basket compared to the other fiat currencies. But the Fed's not going to be able to get away with this for that much longer because of math, like we said earlier. If the U.S., once it enters into an official recession, and the reality is we're dealing with a lot of stagflation here. The stagflation for regular Americans for food, energy, rent, electrical utility bills, all these things are killing consumer discretionary income, killing people's budgets. The consumer is not going to be out eating out at as many restaurants, shopping. That's going to hurt sales tax revenues. And if the Fed continues to hike interest rates, the interest rates on mortgage, what we're already around 6% nationally, I think is the average or slightly above that. If we keep going higher, real estate could potentially collapse. And then the Fed has to come in, and this is part of the math problem. The Fed has to help fund all levels of government when there is tax revenue shortfalls.
Yeah, I agree with everything you just said. And, from a purely technical perspective, the dollar it has had a nice rally, but it's the most overbought on the monthly chart or technically stretched that it's been since 2015. So typically when you're overbought, RSI is stretched, and you're approaching major resistance, you're ripe for a pullback. More often than not, from a purely statistical perspective, you're more likely to pull back. So I'm looking for a pullback in the dollar. However, if we come back and retest and break out through 105, there's really not much resistance up until that 120 level. I think that's a pretty low probability outcome that we rally up to 120. But like you said, if that were to happen, it's important to keep in mind that, when you look at the dollar index, you're measuring it against a basket of, I think, 6 other debt-based fiat currencies that are all losing purchasing power just relative to one another, which is losing purchasing power the fastest.
The other thing here with the dollar and the dollar index, the US Treasury and the Federal Reserve Bank are 100% aware. They watch the dollar exchange rate, especially the dollar index. They're looking at the dollar's exchange rate versus major currencies. The dollar index was actually in March of 2020 when the pandemic first started. It was actually about to super spike and turn out the way Brent Johnson, the dollar milkshake theory, was about to happen. And then guess what happened? You had all of these liquidity program announcements. You had congressional spending programs, all to try to weaken the dollar. Now, I don't know if they could do it to the same level that they did in March of 2020 to smash the dollar back down. But the stronger the dollar is, the more games behind the scenes that the US government, the Treasury, can play to manipulate the dollar. They can also start handing out, and they don't even have to announce this publicly, currency swap lines. We were talking about this before we started recording, these dollar currency swap lines to foreign central banks, foreign governments, and then the Fed can just waive the loans later, because when the dollar gets to these levels, it's like a global margin call on the rest of the global economy because of how much dollar denominated debt outstanding there is from foreign governments and foreign corporations.
Yeah, and you said you're not sure if they can get away with it again, and I think they're going to do that again and do it bigger. It's just a matter of when. Are they going to wait for more of a crisis to develop? And you and I both know the Fed is more reactive than proactive. So I think they'll probably wait for more weakness in general equities, more weakness in real estate and things like that, asset prices, before they really turn on the spigots again publicly with more quantitative easing and things like that.
So if the Fed waits too long, though, and asset prices stay too low for too long, say for 6 months or 8 months or even a little bit longer than that, then it starts to, and we get back to the math problem. Then the tax revenues for the state and local governments and the income tax revenues for the federal government and the capital gains tax revenues for the federal government, these start to drastically hurt. And then guess who has to plug the gap for the funding? It's the Fed. It's the Fed. So they're the buyer of last resort, because unless they start forcing people in their retirement accounts, in their 401ks or IRAs here in the United States to buy, say, 1 or 2% treasuries, they're going to force people to buy US Treasury debt. There are China, Russia, Japan, a lot of the buyers of treasuries in the past of the last 10, 15, 20 years that were running trade surpluses and reinvesting their foreign exchange reserves, recycling those back into treasuries. They're not buying the treasuries. They're not subsidizing the federal government budget deficits. So the Fed would actually, if there is a big tax revenue shortfall, like in 2008 and 2020, the Fed would actually have to buy even more treasuries. Oh, I was talking about if the asset prices do fall and the Fed allows it to continue for a certain amount of time, then the math problem that we discussed earlier just keeps getting worse because all the tax revenues, so sales tax, income tax, capital gains tax, and then there is not foreign demand for US treasuries like from China and Japan that there was in the past, because China and Japan have said they're not going to buy any more treasuries now.
Yep. Yeah, these are all such valid points that highlight just how tight they're trying to thread this needle here. I mean, they're walking on a tightrope, or pick your analogy. But it's such a precarious situation because the asset prices, we could very quickly head into a deflationary spiral or an inflationary spiral. And they're trying to really thread that needle. And, you're raising such good points that if you understand these things and then you look at a $20 silver price, I mean, it still hurts, but it doesn't bother you as much because you understand the fundamentals behind why we invest in precious metals and hard assets and things like that, because there is no solution. Someone I like to follow, Chris Martenson, says, problems have solutions, predicaments have managed outcomes. And this is not a problem because there's no solution. There's only managed outcomes here. And all of them are, unfortunately, not good, not to be a Debbie Downer, but, we want to position ourselves to be on the receiving end of what is coming, down the pike as all of these things unfold.
So I'm looking at the silver price right now. It's $20.17. I mean, the average person who's listening to this podcast, they're not going to be paying that. I think premiums, I was just looking a couple of days ago, they're around $4 an ounce still for a 10-ounce silver bar. So the premiums are still sky high. I mean, almost around 15% premiums for silver right now.
Yeah, once you get down in these depressed levels, if you're looking to accumulate physical, it's almost like every dollar drop in the price of silver is offset by a dollar increase in premiums. So I don't think you're going to get physical silver for much cheaper. But from a technical perspective, it's possible that silver falls down towards the $18 to $19 area. I'm not expecting that, but it's a high enough probability where I've got a plan in place if it does, and we could be potentially see some mining stocks and royalty companies on the deep discount rack, even more discounted than they are now.
So you talked about asset prices falling and the Fed might have to wait for a certain amount of time. Do you think that stocks are in a long-term secular bear market then?
Well, from a purely technical perspective, again, we're below a declining 200-day moving average, and we've already carved out a series of lower highs and lower lows. So yeah, the stock market's in a downtrend. I think the fundamentals support that we're in for probably a prolonged bear market in stocks. But you have to factor in inflation into the equation. So I can see a scenario over the next handful of years where, let's say, stock prices double, but everything else quadruples. Well, did the stock market double, or did it go down by half? And I would argue it went down by half in that kind of scenario.
If people study the history of bear markets, I know a lot of traders don't think this. So a lot of people are shorting. A lot of people are trying to go long treasuries. But if the Fed keeps hiking interest rates, a lot of people on their U.S. Treasury trades, the TLTs and the other treasury trades, those are going to get killed still. So it's basically the Fed has made, it's a Pavlovian response. The Fed has made everything so dependent on their policies now post 2008 about asset prices, real estate, all these different things. So if the Fed continues to hike interest rates, it could get very, very ugly. It really just depends on the Fed and when they decide they're not going to hike interest rates anymore, I guess.
Yeah, so it sounds like we're both in agreement. They're going to pivot. So I'm curious your thoughts as far as like timing. Do you have a time frame where you expect them to kind of reverse course and pivot?
I don't think they have more than 6 months. They've hiked interest rates more than I thought. Things are going to get very, very ugly. This is why they've been delaying the official recession, because once the U.S. enters into an official recession, then you're going to start to see even more business owners in the real economy start to either fire employees or cut back. You're going to see less business activities. The funny thing is, with all the stagflation and shrinkflation, the Fed has been coming out for the last 6 to 8 weeks and saying that they hope that workers aren't hired and that they hope that wages don't go up, which is totally ridiculous because in a flourishing economy, you want your real economy, your workers to do well. But the U.S. government finances are that precarious, and the Fed has been inflating asset prices intentionally to where they didn't even really care as much about the real economy. So it's kind of ridiculous that you've had PhD economists at the New York Fed and on Wall Street, these PhD economists that have horrible real world track records saying that wages were going up too much, there were too many people employed, and that it would be good for the economy if that stopped.
Yeah, it's truly bizarro land. This is supposedly the freest country in the world, and it still is, but it's far from a free market where you've got a couple of bureaucrats deciding what wages should be and what inflation should be and the price of money should be. I mean, it's so far from a free market that it's astounding. The question is, a lot of people think that I like to focus on what we can control, and we're not going to change what they're doing, but we can position ourselves to be, at least on the receiving end or from all these policies that are about to unfold.
So before we talk about gold and silver, one last point here on deflation. So deflation cannot be taxed. This is something that the PhD economists, the people at the Federal Reserve, the bureaucrats in DC, politicians, this is something they don't want to admit publicly. This is why they hate deflation so much. And in a democratic style of government where you have voters and you have voters voting for more free goods and more government spending, and then in a recession, once the U.S. announces officially that it's in a recession and they've been delaying it, then you're going to have people applying for even more social programs and spending. So that means tax revenues fall and government expenditures, historically, at least in a recession or depression, they actually increase. So this is why governments hate deflation, because their expenditures, the government spending, might actually increase and their tax revenues collapse. And then the Fed has to come in and plug that mismatch, that gap, that hole in their math there with government expenditures versus tax receipts.
Yeah, 100%. That's such a good point. And, that's why I've pretty much ruled out the ultimate end game being deflation, because, there's no limit to the amount of currency units they can create. And like you just said, deflation hurts tax revenues. It makes the government's debt burden harder. And, inflation benefits the rich, benefits the wealthy. It increases the wealth gap. I can't see them pursuing a policy that ultimately doesn't end in inflation. So we might see these bouts of deflationary impulses, but the overall trend is here is we're going to see a lot more inflation going forward in the years ahead.
So I want to transition out to gold and silver. What are signs that you need to see in the charts for gold, silver, mining stocks that these shares have put in a cycle bottom and a new bull market has started?
Sure. So really simple answer here. I don't have anything cosmic to share with you, but higher highs and higher lows. That's the definition of an uptrend. So right now, silver is, just grinding sideways between 20 and 30. And what you need to see is a higher high. So the first step is reclaiming the 200-day moving average on the daily chart. And, a lot of people might say, oh, technicals, that's a bunch of mumbo jumbo. I think it matters so much because it's the primary input to these institutional algorithms. They trade off of technicals, and that 200-day moving average is used in almost all of these algorithms. So the 200-day moving average, getting back above there is like the first step towards confirming a technical reversal. Bigger picture on silver, a lot of people are familiar with $30 resistance. Once you get through 30, I think we see, $40, $45, $50 silver pretty soon. But 30 is still quite a ways to go from here. We're still down at 20.
Well, we're going to have to see much higher silver prices in definitely under 5 years and probably under 3 years, because if you look at the earnings reports coming out from silver miners the last couple of quarters, and we're recording this interview again on Thursday, June 30th, we don't have the Q2 numbers out yet for Pan American Silver, First Majestic Silver, the larger silver producers yet. Those will probably be out in the next month for the Q2 numbers. I'm suspecting because of what the oil prices are, diesel, oil, electricity costs, all these costs are up. That's going to hurt miners. Miners use more energy than almost any other industry, or arguably the most energy inputs other than maybe agriculture. So you're going to see a lot higher costs, and the silver prices are lower. I think silver was one of the worst performing commodities in the last 12 months, either one of the worst or the worst. So it's going to absolutely hurt these silver miners. We're going to have to see higher silver prices in the next couple of years, or the mining companies, they're not going to be able to maintain supply. I mean, not even talk about growing supply.
Yeah, 100%. I mean, like you just said, input costs have gone through the roof for these miners, yet, the silver and gold price have gone down, especially silver. So it's like a perfect storm for these mining companies, and that's been reflected in their share price. So, I'm accumulating, I'm scaling in here, even though we could go a little bit lower. And I think you and I have in common, we prefer the royalty and streaming plays. I'm not sure. Is that like, do you also go into explorers and developers at all, or are you purely into the producers and royalty and streaming companies?
So for patrons, I track costs a lot for the mining companies, but for my own investments, the majority of my retirement account in stocks is in the royalty companies for safety. Cool.
Yep.
So I do track the mining industry and costs. I used to own a lot more mining stocks. The problem is that and I studied this a lot, and I've been in the industry almost for 15 years now. So back to 2011, right? So when silver was soaring almost to $50 an ounce and gold was at 1900 back then, what a lot of people didn't understand is that the mining industry costs were rising so rapidly. So the profit margins were eroding very, very quickly for the gold and silver miners back then. The gold and silver miners actually had about 18 months from the first quarter of 2020 to about mid 2021. They had record low input costs. So energy costs were cheap.
Yep.
Governments weren't raising taxes on mining companies. So you had high metals prices and you had low input costs, and that was record profit margins. I mean, these miners were minting free cash flow. They've never had profit margins and free cash flow, some of these miners ever. Their profit margins were that high, or they had not been like Newmont Mining. And you said that the chart's looking pretty good for Newmont Mining. It's starting to bottom out, and it's creating, I think, a really nice long-term cup and handle. But Newmont Mining had never had profit margins like that in decades.
So true. And now we're the polar opposite of that. But I agree with you 100%. I think the royalty and streaming plays offer the most favorable risk-reward profile, for investors. And, we get a lot of new investors. I'm sure you do. A lot of people new to the space, and they go all in on explorers and developers without understanding the risks associated. And that's probably the biggest mistake I see from newer precious metals investors.
And this is something that you would notice too from looking at charts. So if you look at a lot of mining stock charts compared to metals prices for the last 10 years, a lot of these mining stocks have grossly underperformed even though gold prices are still above 1800 when we're recording this interview. So one would think that even though gold prices are up substantially in the last decade, that gold miners would have benefited. But if you look at the mining stock charts for a lot of these gold miners, they have not. But if you look at the long-term charts for Franco-Nevada, Royal Gold, Wheaton Precious Metals, those are the three largest royalty and streaming companies. They have heavily benefited from the bear markets in gold, silver, copper over the last 10 or 15 years because they just do more deals, they grow. So that's proof then a lot of people don't look at charts, but looking at charts of those companies, and there's been substantial dividend growth too. So not only do you have capital price appreciation, you have share price growth, you also have dividend growth with these companies as well.
Yeah, I consider royalty and streaming plays investments where everything else in the precious metal space, as far as mining companies go, they're speculations. You're gambling. But I look at royalty and streaming companies as like an actual investment that has a yield and it's inflation protection. You're jurisdictionally diversified. It's just a beautiful business model.
Exactly. It's an efficient business model. They can have diversification. And what a lot of people don't understand, they can be counter-cyclical. So if we do have a bear market for another 6 months, 12 months of gold and silver and copper prices, and these copper miners, if copper does go lower, some of these copper miners that are higher cost, they may even be willing to sell more gold or silver streams to some of these other companies. So historically in bear markets, since the royalty and streaming companies were started, those companies have actually grown more in a bear market because better deals become available. So they can make those investments counter-cyclically. And then when you do get a reversal with gold and silver prices, those companies then, they have even more growth.
Yeah, such a good point. When gold was up over $2,000 and, everything was trending higher, it's really difficult for these royalty and streaming companies to secure, to avoid overpaying for quality royalty and streams. But yeah, when price pulls back and, sentiment's down in the doldrums, that's the place where they can, secure these accretive deals for long term.
And to add to your point there, I mean, Sandstorm Gold was built in 2008 through 2010 before metals prices took off. So they did their first rounds of deals then when the company was first built. And then they did a bunch of deals when gold and silver miners were close to bankruptcy in 2015 and 2016. Those deals are bearing enormous fruit now, and that's why the company just paid out its third quarterly dividend.
Yep, 100%. That's actually my single stock holding is Sandstorm Gold.
And we're not getting paid to promote Sandstorm Gold. I mean, but if you just look at the fundamentals of the company notes, a very solid mid-tier company now with a lot of growth already paid for, diversification, and they just started a dividend. So the assets are maturing now and throwing off enormous amounts of cash flow.
Yep, 100%. And from a technical perspective, the longer term chart looks really nice. The longer term monthly chart, you've got a big triangle pattern forming, which should resolve in the next few quarters. And then on the weekly chart, you've got a nice cup forming. It is below its 200-day moving average, but compared to other precious metal stocks, the chart looks pretty constructive here for Sandstorm and a lot of other stocks as well.
I was actually going to ask you about that. Do most of the gold miners that you look at, that you cover, have similar charts, or do some of them have better charts, like they are within a few months of being done with any corrections? The bottom is very close and maybe a breakout if the Fed does announce some type of reversal, and then you start to see gold spiking again.
I would say the more quality top tier gold miners look pretty similar, but it's like those junior silver miners are just beaten to a pulp. I mean, the only thing you can say technically is that they're just oversold and, hated right now, but I'm not seeing any like clear patterns or, trend in the junior silver miners, but some of these gold miners actually have pretty compelling charts. Like gold itself is above its March 2020 uptrend line. It's hanging right there near the 200-day moving average. So the gold and quality gold miners actually don't look too bad from a technical perspective.
I interviewed Jordan Roy Byrne from the Daily Gold about a month ago, and he said that gold would bottom. And he's normally not bullish on gold. He's normally actually pretty neutral or bearish on gold or silver prices most of the time. But he thinks that gold will bottom in the next 6 to 9 months. And then he thinks $3,000 gold in under 3 years. So do you think that that's reasonable to assume those things?
I do. I like Jordan a lot, and I like how he's unbiased. I try to be the same way. From a long-term perspective on the chart of gold, anyone who looks at charts is familiar with the cup and handle pattern in gold, the 10-year cup and handle pattern. And you can provide a measured move target out of that pattern. And there's two ways to get a target. You can flip the handle portion. So it's about a $400 cup from 2089 high down to about 1675, the recent low. So if you add $400 to 2089, that brings you up to about $2,500 as a target. But the more common way to do that is to flip the cup over. So, 2089 down to 1045 was the 10-year low. So that gives you a measured move up near $3,000. And I think that's where he comes up with that target. And that seems totally reasonable to me from not only technical perspective, but also, fundamental perspective. And honestly, I think we're going much higher than that over the coming years. But in the next year or two or three, I think $3,000 is very conservative.
Well, if mining costs keep rising, Steve, I mean, the mining companies, $21.50 an ounce, with all these costs going up 10, 15, 20% per year, sometimes even faster than that, depending upon which country. It's very expensive to build a new mine. I think the costs, depending upon the country, the cost to build a new mine are up 50 or 60% in just the last 2 or 3 years. That's how much the cost increases are. We're going to be looking just to build a new gold mine. The gold miners are going to need a much higher incentive. We're going to need gold prices way above $21.50 for the incentive for miners to even think about bringing on new mine supply. And for silver, we're looking at way above $30 an ounce. We might need $35, $40 an ounce in under 5 years just to build a new mine for it to be economic with all these costs are up.
Yeah, it's such good points. It's almost hard to overstate just how undervalued silver is if you've got a 1+ year time horizon, because anything can happen in the short term. But yes, I mean, silver, it's the only commodity on the planet that's trading below where it was in 1980, 40 years ago. And not only is it less than where it was 40 years ago, it's less than half of where it was. It's crazy how cheap silver is. And it's that industrial component too. It's going to be needed more in industry, especially if they're pushing this, the green agenda and solar panels and all this. So, this $20 silver price, I mean, it's frustrating that it's down this low, but if you can kind of flip that around and look at it as an opportunity as well, that's kind of what I do. I mean, I would almost welcome a pullback to 18 because I know I'd be able to scoop up some bargains.
So I want to transition now to uranium, which you also cover those companies. The uranium spot price right now, it's below 50 for the first time in months. It's at $47.75. The long-term contract price, according to the Cameco website, is still above $50 at $50.75 a pound. What are your thoughts on a uranium bull market? Because, in the short term, we had the uranium spot price pull back. But I think long-term, the uranium stocks are in a really nice long-term bull market, especially with this green energy agenda you mentioned. If these governments want to actually reduce carbon emissions and fossil fuels, wouldn't nuclear power make a lot of sense then to build nuclear power plants?
Yeah, 100%. And for the first time in decades, if not ever, both sides of the political aisle and spectrum are supportive of nuclear as a green energy alternative because it's zero carbon emissions and it's baseload power. So it's reliable. It's 20% of the U.S. power grid is powered by nuclear. We import pretty much 100% of our uranium for 20% of our power grid, but it's baseload power. And so it's the first 20%. So if we go into recession or even depression, the demand doesn't really get affected that much for uranium. And we just talked about higher prices. It used to be around $50 was the price needed to incentivize new production. But with all these input costs going up and inflation, the new like $70 is the new 50. So that we're probably going to need at least $70 uranium in order to incentivize the production that's going to be needed to meet the growing demand for all these reactors that are coming online around the world.
And the other important point you mentioned is the U.S. does not have the processing facilities. So we do not have, the U.S. Department of Energy will not approve taking the uranium after it's mined and then enriching it. So we've been outsourcing all of this. And unfortunately, it's been outsourced to Russia. And now all the U.S. federal government, the foreign policy stuff and the tariffs back and forth with Russia, it's just a mess. We need domestic supply here. We need enrichment here in the United States. That's not something the free market, because you have to, with nuclear power, you have to get all these government permits. It's a mess.
Yeah, 100%. And you just talked about price pulling back. The recent high from, let me get an exact date here, mid-April, let's just call it mid-April, it reached $63.85, the spot price of uranium, and we've pulled back to just below 50 now. From a technical perspective, we're still in an uptrend, but that previous high at 63.85 is now going to be resistance. It could take a few months or even a few quarters to get back up there. But once we eventually get through 63, I think 73 becomes the next target. And then you've got previous highs around 95, and then there was even a spike high up to $140 in uranium back in 2007. And I think we'll probably take that out in the fullness of time over this cycle. But all that to say, there's a lot of upside ahead, I think, for uranium.
What are your thoughts on the charts for the oil price and the copper chart? Because I think those are important. Those signal the global economy. The global economy right now is dealing with two very difficult things. So if the Fed continues to hike interest rates, that's going to break a lot of things because of the amount of leverage that these hedge funds, these asset managers, even retail traders now that borrowed a bunch from their stockbroker account for margin or for crypto trading. So the more Fed hikes interest, and then of course in real estate with mortgage prices and refinancing. So if the Fed continues to hike interest rates, the other thing is the oil price. So if the oil price, let's say in 2 or 3 years from now, we do go above 150 a barrel. I know hedge fund managers that have studied this. They think oil is going to 200 or 250 a barrel in 2 or 3 years. They think the energy crisis is going to be that bad. Do you think that that could collapse everything as well?
Yeah, I think it was James Poplava who a few years ago said the price of oil is the new Fed funds rate because, it acts as a headwind or tailwind to the global economy as prices rise or fall. And we've pulled back quite a bit here. I'll be honest, oil is not my primary focus or one of my primary focus, but copper, I look at this chart every single day and I follow the copper market very closely. And we got up to a high on March 7th of just over $5. That was major resistance. Poked our head above it and came back down. And here we are now down around 350 copper. So copper's pulled back quite a bit. And you can almost make the same arguments for copper as we just did for uranium, although there's some nuanced differences. But the bottom line is the world's going to need a lot more copper. We're headed into a structural supply deficit for copper. It's been underinvested in for years and years. And we're going to need a higher price to incentivize that new production. And I think copper makes a compelling speculation. Or even investment for the longer term.
It is very expensive to build a new copper mine. So for a medium-sized copper mine, for a mid-tier copper miner, you're looking at over $500 million for a new copper mine. And that was 2 or 3 years ago. So it's some of these mid-tier, and these aren't even large copper mines. A large copper mine is going to cost billions of dollars. There's enormous cost overruns for the Oyu Tolgoi copper mine, which is going to be one of the largest ones in the world. That one is in Mongolia. The underground portion of the mine, I think they're billions of dollars over in construction and costs. It's been delayed for years. So these giant copper mines, they take a long time, billions of dollars of capital, they're delayed. And these older copper mines, as you mentioned, they've been running for decades. The reserves, the production, these things are all depleted. So the underinvestment there, the costs for mining are up.
Yep. Yeah, 100%. And, what's interesting about copper mines is they last for decades, much longer than a gold or silver mine. So, I like the idea of royalty plays on copper as well for like a longer term hold.
Well, actually, Sandstorm owns a lot of copper royalties. So Sandstorm has good exposure there. And then Sandstorm's about to spin out. I don't think it's publicly traded yet, Horizon Copper. And they're going to own copper royalties and streams, and they're going to own copper mines. But then the other one you have, I don't know if your company, Silver Chartist, covers this, you have Altius Minerals. So Altius has a lot of base metal exposure and royalties and streams. I think they're cash flowing around $80 million a year. So they have like royalties and streams on like potash, coal, copper, other base metals. It's an interesting company.
Yeah, for sure. I don't cover that one super closely, but I like what you said about Sandstorm there. And that's such a good point because when some of these royalty companies, and I don't want to sound like a commercial for Sandstorm. That's not that's not my, like I said, I don't get paid from these guys at all. But I just like the company a lot. If you're a royalty company and you have base metals mixed in with precious metals, the market tends to value precious metals royalties at a higher valuation than base metals. So by spinning out the copper and making it separate, it just makes a lot of sense. And also, they may be in different cycles. Like for example, there may be a point where I want to take profits on gold miners, but copper still has a lot to go. Well, if it's all rolled up into one company, it's hard to do that. So I think I like how they're separating that out, copper and precious metals.
And you cover battery metals, right? So there's some new battery metals royalty companies. I think there's a small one that just started off as a spinoff, but I know that the entrepreneurs up in Toronto and Vancouver, they're actually planning new battery metals royalty and streaming companies in the next 12 to 24 months.
Yeah, I was invested in one and I sold it. We just couldn't get in touch with the CEO or anyone from management. After multiple emails, which, I like to have that open line of communication. But yeah, there's some exciting companies on the horizon, like you said.
And if there is a bear market for commodities for, 6 months, 12 months, that's actually the ideal time to start a new company because then assets become at a discount. So if you have cash and there's a commodities bear market, it's a buying opportunity. Some of these really good commodities companies, they actually grow or they start during a bear market.
Yep, 100%. Yeah, not much really to add to that. But I remember thinking, as gold prices were starting to run away and everything was in an uptrend, it's going to be really hard for these royalty companies to secure new deals. And that's the time where they just sit. So the good ones, the quality ones, were kind of patient and didn't avoided that temptation to overpay for royalties and streams. And now, now's when they can start going shopping.
Well, you've also seen 2 acquisitions in the last month or so. You saw the lowest cost mid-tier gold miner, Yamana Gold, was just taken out recently at a substantial premium. And then Sandstorm Gold just bought Nomad. So long term, in the short term, that deal might not make a lot of sense. But in the long term, Sandstorm just added a bunch of growth that's already paid for. And I think they paid around 4 times cash flows for all that growth that's already paid for. So 2, 3, 4, 5 years from now, that type of growth that was added at a reasonable price paid, it's going to pay off big.
Yep, agree.
Okay, Steve. So I want to thank you so much for your time. Please tell my listeners more about Silver Chartist Pro and what you guys do over there with your research and what types of companies you cover.
Sure. Thank you for that. I call it a fully transparent over-the-shoulder service with real-time alerts. And what that means is I just show our members exactly what I'm doing. I explain why I'm doing it, not because I'm perfect or anything like that. That's far from the case. But hopefully by seeing someone do this who's been at this for 15 years, it helps members make better financial decisions on their own. And there's also a community aspect as well. I'm just checking out your service too, and it looks really compelling. So I don't want to just sit here and plug mine, but your service looks fantastic as well.
I charge a very low price for that because I want people to have good information. So I was actually warning people about the oil price that OPEC didn't have the spare capacity because I was reading hedge fund research about 8 months ago. So all the articles that are coming out now saying OPEC doesn't have the spare capacity, my patrons were getting this information 8, 12 months ago that OPEC was already, even though they were raising the production quota and all the people were short oil 12 months ago, saying the global economy is falling, there's going to be deflation then. You had the big oil super spike before the Russia-Ukraine stuff was even hitting public. OPEC was already having big problems before that.
Yeah, fantastic.
Well, I really enjoyed our conversation today, Steve. Thank you so much for your time.
You bet. Thank you, Jason. Really appreciate it.